Hello everyone, thanks for checking out my video. Time flies and we are entering a new earnings season again. This upcoming earnings could be a pivotal one, where either we get a big pullback if the earnings disappoint, or we could rally to a new all-time high for the major indices if companies continue to report results that are better than expectations. Meanwhile, last week the market faced a new pullback as suddenly the fear of aggressive rate hike campaign by the Federal Reserve gets revived. There are a lot of things to watch in the next 2 to 4 weeks, so do stay tuned to this video as we discuss them all. Last week was a holiday shortened week, and the stock market has its latest pullback. It seems like Wall Street has finally digested the two possible rate hikes that Powell has been talking about. This was probably reinforced by the mixed job reports last week. In essence, the latest job report suggests that labor market is still strong and wage numbers are still stronger than expected. This could translate to more spendings by the consumers and may cause inflation to stick around longer than expected. As a result, Fed is likely to materialize the two rate hikes that they have been mentioning. And in case you don't know, high interest rate environment will affect companies' profits, growth, etc. So yup, this is likely the cause of the recent pullback where all three major indices kept a losing week. This week is an important week. Not only it is the start of the earnings season, investors and traders will be wary of the new CPI number that is set to be released on 12th July. For the last don't know how many months, CPI data has been trending down. Therefore, I cannot imagine how would the market react if the inflation number somehow ticks up. But remember, don't try to predict the CPI number, so don't bank on it going up or down. Just grab some popcorns and wait for the number to be released and then observe where the market is going. From there, you trade the trend after the market finds its next direction. Meanwhile, on the earnings front, as usual, we will kick things off with the major US banks, where JP Morgan, Wells Fargo and Citigroup will report their earnings on 14 July Friday. Bank of America and Morgan Stanley will report the following week on 18 July Tuesday. Their conference calls could help to shed some lights on the US economy in the second half of the year, so if you have time, you may want to listen in a little bit. Last but not least, the next FOMC meeting is on 25th to 26th July, where the market is pricing in a 92% chance of a 25 basis points rate hike by the Fed. That's according to CME Group's Fed Watch. And I thought to just highlight that week, it is estimated that a few mega cap tech companies will be reporting their earnings, such as Microsoft, Meta, and Amazon. Therefore, high volatility and whipsaw movements are expected, and if you have options expiring by the end of the month, do have some plans in mind. Moving over to the technical analysis segment, there is something on the chart that is so obvious that I saw it immediately when the market closed on Friday. But before I share that, just wanted to highlight that in my very last video, I highlighted that I personally didn't like the gap up rally we had. And if 443 does not hold, we will fill the gap easily all the way to 438. And ladies and gentlemen, SPY closed at 438 on Friday, and I hope this technical analysis can earn me some likes and subscribers please. It will really help out with this channel as I continue to provide these content for free. So back to what I saw when the market closed on Friday. There is none other than this ugly looking gravestone doji candlestick. What this candlestick signifies is that there was a bullish advancement at the start of the trading session, but then the sellers overwhelmed the buyers by the end of the session, and thus pushing the price down to where it opened. This means bulls were losing momentum and indicates a potential trend reversal, aka a downtrend. Okay, but before bears get too excited, especially after tasting some blood last week, here's the thing. In technical analysis, you cannot only rely on one indicator, you have to use it in conjunction with other indicators to look out for confirmation. So now let's check out other indicators. Firstly, on the RSI, we do have a bearish divergence. Then SPY fell last Thursday and Friday to fill the gap. Therefore, you can say that the bearish divergence has played out, but will it continue? It's anybody's guess. What didn't help is that the RSI is sitting at a neutral level right now, which means it can go up or down. Okay, before you say that that's equivalent to not saying anything, well, all I can say is, though not guaranteed, but it does have room to fall. In addition, it does appear to me that we have a little double top pattern forming, and that's a bearish sign. And then in terms of MACD, it has curved back down last week. That's also bearish in my view. Volume wise, it's not very high, so it's inconclusive. Come this week, the bear should watch for two things. First, watch whether the next two candlesticks are green or red and at which level they close. If we print two nice green candles with good volume, then the bearish thesis could be invalidated. But if we get red candles plus broke below the 20 moving average of 436, then the bearish thesis could pan out. We could then start testing sub 430s. I know it sounds a little stupid to call for a bearish thesis in a bull market. Well, again, I am just merely reading off the chart and try to be as unbiased as I can. Anyway, if you are banking on this bear thesis to trade, my view is please set a stop loss and be prepared to exit if the bear thesis does not play out. Okay, on the bullish side, as mentioned, if we have nice green candles in the next few days and especially if SPY starts closing above 443, it will invalidate the bearish gravestone doji candle and the double top pattern. This means the temporary pullback is done for now and the uptrend has resumed. Above 443, the next resistance is around 452 or 453 level, where March 2022's high was, and that's where the top end of the uptrend channel sits. And mind you, if we hit this resistance, it means we will be creating a new 52-week high. That's super bullish in my view. And if we break above these double resistance levels, come on bears, you will have to exit your shorts until the trend reverses again. Okay, that's a lot of sharing for SPY alone this week, but as you know, SPY represents S&P 500, aka the broad market, so it's good to watch and know where the overall market is heading or trending. Alright, let's now move over to the most valuable US company, Apple. Apple seems to be hitting resistance at the second Fibonacci extension level at around 195, and it is currently sitting between two Fibonacci levels as you can see from the chart. For Apple to unlock the 200 level, aka the next Fibonacci extension level, it needs to break above 195 decisively. Well, the usual stuff, about two green candles with decent volume. Once Apple does that, it is a very high probability that we will punch through the 200 level. So maybe traders can consider buying calls with $200 strike price if Apple can reclaim 195. Not financial advice, of course. Anyway, so long as Apple does not break below 187 support level, I would say Apple is in a little consolidation phase, waiting for its next big move. On the downside, again to watch out for this 187 support level because that's also where the current 20 moving average sits. It's a dynamic support level that has held since March this year when Apple embarked on this parabolic run-up. If you notice, whenever these levels gets breached, Apple bounce back up quite quickly. I mean, as you can see, so far we have only printed one candle below it on 3 occasions, and each time, Apple reclaimed this level almost immediately. Therefore, to the bears out there, if we have 2 red candles below this level, you should get a little excited. And if we see MACD starts crossing down convincingly, it could be a signal of a short-term downtrend. Some other support levels to watch would be the 50 moving average at around 178 as well as August 2022's high of 175. Do note that 175 is also where the bottom of the gap is. Moving over to my favorite Tesla, a quick look at the chart, it just shows me one thing: gaps everywhere. As you can see, we have 3 gap up when Tesla went on this bull run. So anyway, just to share, after the market closed on last Thursday, I saw a few bearish signs on Tesla's chart, and therefore I posted on Moomoo before Friday's market open, and Tesla closed the day red. Let's now dissect these bearish signals. Firstly, there was a bearish RSI divergence which it played out with 2 red candles. Next, can you see this super long red dotted downtrend line? Tesla seemed to have some difficulties breaking above after testing it for 4 consecutive days. It basically got rejected. The other 2 bearish signs were Tesla went below the recent high of 277 and MACD had a bullish cross but could not even sustain for 2 days. To add on a switch over to the weekly chart, we can also see a bearish shooting star candlestick. This means that as the week progressed last week, sellers stepped in and pushed the price back down to where it was at the start of the week. For confirmation, the next candle's high must stay below the high of the shooting star and then proceed to close below the close of the shooting star. Therefore, this week is quite important, especially when Tesla reports its earnings next week. Alright, a quick one. I just wanted to thank those viewers that have liked and commented on my videos. A huge shout out and thank you to all of you. Meanwhile, if you like the content that I have put out for free on an almost weekly basis, I hope you can help out the channel by simply tapping on the like and subscribe buttons and also comment something below. They say it will help with the YouTube algorithm stuff. I'm not sure how true it is. Anyway, other form of support includes signing up for a Weibo account using my referral link or buy me a cup of coffee at USD $3. Alright, back to business. This week we can expect Tesla to test the red downtrend line again. If sellers keep stepping in, I think we will start feeling that gap between 264 and 277. That gap up was created because Tesla managed to beat its delivery estimates, but it seems like we could have a buy the rumor, sell the news scenario. Anyway, if we indeed feel that gap, no big deal, it's completely normal. Important support zone is at 253 to 255. 255 is a level that has turned from resistance to a support level, while 253 is where the first Fibonacci retracement level sits. So if this area breaks, I will be excited as the next gap, which is between 235 to 240, will act as a magnet to draw Tesla towards it. I personally would love to pick up some shares here. On the other hand, if somehow Tesla decides to rally, watch for that downtrend line again. If it breaks above it and close above the recent high of 284, that's when the earlier bearish signals could be invalidated. And if Tesla starts kissing 300, bears may have to consider exiting their short positions, because bulls would almost definitely bring it across the 300 line if it gets tested. Don't forget, there is a strong cult behind Tesla, though they say it's heavily manipulated by institutions. Above $300, I can only see the next meaningful resistance at around 315. So option traders, you may consider 315 call option if Tesla starts kissing $300 level, with maybe stop loss as a precaution of course. Because when Tesla wants to fall, it can fall quite quickly because the way institutions like Katie Wood unload their shares, it's massive. Once again, this is not financial advice, okay? Let's now check out Google. Since Google hit a high of 129, it has been on this short-term downtrend marked by the two purple dotted lines. That's the downtrend channel. The top end of this channel will act as a resistance, which means this week, Google may try to test the top trend line again. Coincidentally, that is also where the 23.6 Fibonacci retracement level is, at around 122. You can give and take a little bit till say 120. So in short, watch out for 120 to 122 area. If Google gets rejected again, we do have some room for the downside. As you can see, the bottom end of this channel is near 115. With that said, I do think the 50 moving average and the 38.2 Fibonacci level should act as a double support. And this area is around 117 to 118. If this area breaks, then yes, the chance of us falling to 115 is high. And of course, we may end up filling that gap between 112 and 114 as well. For the upside, it's very simple. Reclaim that 120 level, a level that it has difficulty in breaking through. Actually, over the last 2 weeks, Google did close above this level, but it could not sustain. That's the issue. So we need 2 or maybe even 3 days above it to confirm that we are breaking out of this downtrend channel. For full-blown breakout, we are talking about closing above 125. Then that's when FOMO buyers may just step in to push it to 130's range. Overall, Google is just moving in a tight and somewhat predictable range, and I realize this is Google's trade. It consolidates and then suddenly it has a huge move. So you may want to be a little careful if you are trading Google options. That being said, if you can catch the trend well, it often benefits option sellers like myself. And that is also why I think I have more option trades on Google than others. In fact, I was intending to open another trade last week, but it didn't get filled. Okay, this then brings me to the next segment, option trades. So last week I had one trade that expired, that is none other than this covered call on Tesla that was sold on 31st May. The thought process behind this trade was covered in the video link at the top. Anyway, the strike price was $285 and Tesla did not close above $285. Therefore, I profited the full premium of $110. Not a lot, but I will take it. Anyway, I wanted to share that back then when I first sold this covered call, Tesla needed to rally 40% to hit my strike price. And guess what? Tesla rallied close to 40%. And as you can see from these screenshots, the trade was in the red most of the time. On the reddest day, it was down 940%, and right now it's up 100%. That's like 1000% swing. By sharing this, I am not saying I am good or what. In fact, I have to admit I am a little lucky to reap the full premium for this particular trade. I'm just being honest here. The main point that I want to deliver is Tesla is super volatile, so if you are not prepared to deal with the volatility swings, you may want to stay away from Tesla's options. Alright, so because Tesla rallied over the past few weeks, I have this cash secured put that is quite green at the moment. It will expire on 21st July, and as long as Tesla does not plummet to below 195 on that day, this contract will expire worthless and I get to keep the full premium. For this week, I will try to find opportunities to sell a covered call and a cash secure put. For covered call, I will likely choose a strike price that is super far away. The premium may not be fantastic, but to me, every $100-ish does add up to more than $1,000 in a year. As for cash secured put, let's see if Tesla starts filling some of the gaps, and if the price and time are right, I may step in to sell a cash secured put. All being said, do note that Tesla's earnings is coming up, which means there could be big swings in the stock price. Therefore, please be careful if you are trading Tesla. Alright, some end thoughts to wrap up this video. In the last 2 weeks, indices such as Nasdaq and S&P 500 were actually moving sideways with some minor pullbacks. This is a breather that I have been talking about, and it is healthy and constructive in my opinion. From a bigger picture, it seems like the market is setting up for a next big movement as we enter the earnings season. As mentioned at the opening of my video, this earnings season could be pivotal in deciding if the current bull run can continue into the summer. If the earnings disappoint, I think we can expect some form of significant pullback or even a correction. Just to share, the definition of a correction is a 10% or greater decline. But quick disclaimer, I'm not saying a correction will happen. What I mean is don't be too shocked if we have a correction, especially if earnings disappoint big time. Well, personally, I will be super excited if we really have a correction, because to me, that's a very good buying opportunity for people who have missed this 2023's rally. But here's the question, how do we know if the pullbacks, if any, are not something bigger in the making, such as a crash? Well, that's when technical analysis will come into picture. Watch out for critical support levels. These levels have to hold to prevent a waterfall in the stock market. I usually cover these levels in my technical analysis segment, so do subscribe to my channel for weekly updates. Overall, my view is that the bull market wants to run, just that in the near term it is hitting some resistance, and we are at this point where big institutions could be holding their horses as we await the earnings season. This could then lead to consolidation and some choppy actions. As per what I have usually shared, if you are scared of missing out on more rallies, you may consider dipping your toes in bit by bit starting from now. Some good companies are still not super expensive yet. The reason for entering a little bit now is because if the earnings turn out to be good, the institutions will step in really fast and you may then miss out on more gains. But if earnings disappoint and the market declines, well, that's your chance to unload more cash to pick up more shares of fundamentally good companies. Though I don't know if the current slide will be a mild or a huge one, I personally am standing by to buy the dip. In fact, I did so about a few weeks ago and I shared that in my videos. So I am looking at doing that again if the opportunity presents to me in the next few weeks. So how about you? Are you buying the current dip? Let me know in the comment section below. With that, I have come to the end of the video. Please remember to help out the channel by tapping on the like and subscribe buttons. Thank you.